what you are working with. Hopefully we will have a more settled and not a one-way day, but of course, nothing like what we saw on Friday with that big sell down and that big recovery coming through as well. Mid-cap index is up about a quarter, and I think with the small-cap index, which are also starting slightly in the green. First rates and lots to track. We'll look at the indices and we'll get to individual stocks as well. So not very much to show as far as the first trades are concerned. We are absolutely flat, but blinking red and green. 24,765. Nifty Bank 0.25% lower. 53,470, 460. The Sensex is starting slightly lower, 0.12%. The mid-cap index is up about 0.25% or so. So I reckon even in the first within the first minute or so of opening, more action as far as broader markets and some of the mid and small caps are concerned. The heat map should come up on your screen, give you a quick sense of what the start is looking like. And there you go. More down than up. 30, I think about 25, 30 odd names are lower, and the others are starting up in the green right now. So not very much to really show for it as far as the index is concerned. 24,733. We're starting about 32 odd points in the red. Let's just quickly look at a few stocks as we kick off things here. And I think Nigel is with us. So Nigel, why don't you take us through stocks?
Well, that's right. A few stocks that are moving around today. You have Happy Forgings. They bagged a 140 crore order to supply crankshafts. So that stock is up close to around 5%. You have HBL Power. They bagged an order for around 1,522 crores for Kavach equipment for one of the loco works. So that's why, in fact, that stock, has done quite well as well today. That one is another one that's buzzing around. RITES bagged an order for around 300 crores from MEA for integrated check posts. That's another stock that's buzzing around in trade today. Dixon Technologies, they have signed a binding term sheet with Vivo India to form a JV to undertake some OEM business here in India. And in fact, that could throw up a big opportunity. Stock at a fresh high, making another high in this morning's trade. Lokesh Machines, Mahindra & Mahindra has cancelled the supply of auto components orders. Keep an eye out on that stock. And also keep an eye out on Bombay Dyeing. The volumes are fairly decent right now. Reports suggest that Mr. Jay Vadia is returning as the director of group companies. It's seen that he's going to retake top position as an MD at Bombay Dyeing. So that could be another stock that's in focus. But a good start to trade, particularly for the broader markets. The breadth of the market is telling you a picture. 1,500 stocks advancing for just 500 stocks that are declining. Though the headline index is down 20 points, you'll have to say that's a good start to trade today.
Oh, absolutely. And, broader market, I think, is what makes all the difference. 3-1 in favor of advances as we begin the day. The biggest volume-led gainer, by the way, and it's all broader markets, is HBL Power. It's about 730, huge. I think it's a 10 bag over the last 3 years. And it's up 5%. Large volumes are coming through as well. This is a big underperformer. Cosmo First, stock's up about 7%. It's really not gone anywhere. But from the lows, it's come up a little bit. 740 was the recent low, and back to about 890. The only reason I'm mentioning is because volumes are really high. I think Nigel mentioned AFCONs. So these railway rolling stock names, Kernix, for example, is up 5%. Maybe we could look at some of the others like Titagad, the RVNL and the IRCONs, etc. Of course, need no special reason for those stocks to do well. But these have been doing well. Last week, I think they did well in the second half, and they're doing well today as well. Premier Explosives, I think, 7.5%, 8% higher. Decent sized volumes again here. And Wockhardt Pharma is starting with about a 4% pop this morning to begin the day. On the downside, Angel is the top number one volume-led loser. It's down 1.5% in terms of price cut. Ixigo, the OTA, is down about 2.5%, 150. Newland Laboratories is down about 1.7. KPR Mills is down about 2% or so. Titan is down nothing. Actually very small, 0.5%, 1%. Those kind of changes are coming through. And maybe just take a quick look at Gokuldas Exports as well, because last 3-4 days, it's come up very, very nicely. I think it left off at about $1,200 and took out its, for 12 months stock did nothing and then saw a sharp breakout over the last 6-7 days. and now it's okay, 1197 or so, so not very much on it. So 40 points to show for it, but this is the very sort of initial couple of minutes of market open. Let's get an outlook going for 2025. Last couple of years have been great. What is 2025 going to be like? We have Gautam Chachoria, Head of Global Markets India, and Tanvi Gupta Jain, Chief India Economist at UBS Securities India, joining us right here in our studios. Gautam, Tanvi, great to have both of you here. Appreciate your time. So, I mean, let's just start at a very simple, basic level. It's been a good last few years, right? I'm actually outstanding if you look at broader markets, not measured by just the Nifty per se. 25, Gautam, are you starting with a positive skew, very positive skew, or kind of a more tepid kind of, what are enthusiasm levels like?
Well, I'll start. Thanks for having us here from UBS. Yeah. I'll start with a mix of two things. One is our EM strategist. He's still underweight India on a relative basis for 2025. If I speak to investors and then the feedback I'm getting, look, it basically boils down to policy stance and reforms agenda. India underperformed last few months largely because of the earnings miss and growth surprises, not necessarily because of India, China, and what's happening globally. Those, in our view, were small factors. The bigger factor has been the slowing growth here.
And you said policy stance.
Policy stance.
Monetary or fiscal?
Monetary and fiscal both. And monetary also, Tanvi is the expert there, but mix of both rates as well as a liquidity stance.
And you think the slowing that we've seen in the recent months is because of that?
You could ascribe a large part of that. Again, both monetary, one of them doesn't work in itself. It has to be together. So when both of them were, in a way, slowing down or forcing growth slowdown, in totality, we saw the surprise or negative surprise to some extent in 2Q earnings or in the GDP prints.
So that gets us to Tanvi. It's all stance, both fiscal and monetary. On fiscal, there is broad agreement that government spending there's no option, but it has to pick up in the fourth quarter. Monetary, it's kind of less clear. So just your first thoughts.
Sure. So if you look at the growth momentum in India is clearly slowing. And I think early 2025 we'll get to know what is the likelihood of US imposed tariff hike on China. And that will definitely lead to more downside risk, not only for India, but as well as the global economy. So I would say India definitely needs a monetary as well as a fiscal policy support. Fiscal policy at this point, we have seen the government capex spending has been lagging. Year to date, capex is down 15%. Even if I expect that the government will be increasing the capex spend by 30% in the remaining 5 months, the full year capex is only going to be 4%. So clearly, I think at this point, there is definitely a need for monetary policy support as well. We have a 75 basis point rate cut expectation starting the Feb policy of next year. Obviously, a focus will be more on how and the timing of the rate cut, especially with the weaker FX. But looking at the real policy rate in India, adjusted for the GDP deflator, at the upper quartile or the 10-year upper quartile, definitely there's a room for a rate cut in this cycle.
Okay. Hi, Tanvi, as well as Gautam, and good to see you all in the studio. Thanks a lot for coming down. Well, a quick question on the current GST rates. I was speaking to a couple of experts last week, and some of them indicated maybe the government should look at lowering GST rates. That could be one of the measures. Do you agree or you don't think so?
I think in the past we have seen that if you reduce the direct tax rate, it may not have a direct impact on the economy because I can use that lowering of income tax rate to boost my savings rather than really boosting my consumption. But a cut in indirect tax rate generally tends to have a much larger impact on consumption spending because it's a tax on consumption rather than a tax on my directly income levels.
Yes.
But I would say a GST council has to decide. It is not so much to do with the government. Yeah. Eventually, the GST council has to take a call. And the GST collections have been buoyant. The tax revenue in India has been buoyant. So maybe we can look at specific products where we want some easing in the GST rates. But definitely one idea which is already going on in the market and should have or should bode well more for consumption. Okay, on select items, maybe some kind of a cool-off could bode well. Well, Gautam, you come in. You've given us an answer with regard to 2025. But you stop short of giving us estimated returns. 2025, which way would you be leaning? Mid-single-digit returns or high single-digit returns? Or do you think that we could brace for a difficult year, which would mean a negative year in terms of equity market returns for 2025?
Look, there are many moving parts, as always is.
Indeed.
Even more so now, given the global backdrop of post-US elections, the policy stance there, as well as, look, there's a lot of hope building out around fiscal and monetary. And I'm less worried about what happens to FY25 GDP print and what happens to 3Q or 4Q earnings. I think that's gradually getting priced in by the market. Market knows that growth recovery, if at all, will be slow.
Yes.
What's critical is what scale this policy stance happens at, and therefore what's the outlook for FY26. And I think that's where it boils down to whether it's going to be a tough year or whether it was going to be a single year, double-digit year. Look, valuations in India, I'll worry less, given the flows locally have remained resilient. And I don't see any reason, talking to all the key clients who have these flows coming in, it's stopping anytime soon. So if the flows will remain resilient, I won't worry about valuations or necessarily market correcting in a meaningful way. Consolidation phase or single-digit, double-digit will depend, to me, boils down to policy stance and reforms agenda. And I'll not underemphasize the reforms agenda part. Look, India also has been a big reform story over the last few years, which has given hopes to market that the long-term growth in India looks exciting. That's taken a backseat along with the short-term earnings and short-term growth, because elections, post-elections, now there's no election happening.
There's no excuse.
No happening for many months now. So whether we see a reforms agenda back on the table in the budget, post that, pre that, I think that also plays a role.
Since you mentioned earnings a couple of times, FY26, what are you all penciling in terms of earnings? Because FY25 is not going to be as good as what we thought at the start of the year. FY26?
Look, analyst expectations in India always is that you have a recovery next year and we go back to low double digits to high single digits. That's a broad range, depending on the sector you look at. But the question is not just that. It's what markets start believing in. If it's going to be a double-digit earnings growth, which is linked to the policy stance, I think markets will be fine. We should still expect a single-digit or even low double-digit returns.
How was 24 in terms of, I mean, so UBS now, do you have a lot of mid-cap coverage, Gautam?
Yeah,
mid-cap, small-cap? Yeah. That's where the interest is, right? Isn't it?
It still
because
is.
The larger conventional sectors, I mean, it's a bit thunder. But broader markets, it's exploding. I mean, the interest levels, activity. So just,
So look, that's a space we want to keep building our coverage on. But going back to where market interest is, clearly among the foreigners, if you go back many years, it used to be the big private banks, consumers, IT services, and that's what's been not performing that well in the last 2, 3, 4 years. The interest is broadened out dramatically. We all know, we spoke about industrials, etc. That's not going to change in a hurry. Even now, despite the weak earnings or earnings cuts, those sectors, the cyclical sectors, are still seeing good growth compared to the rest of the markets. So I think that's a continuing trend, and that's what we want to tap on by expanding our coverage. Even today, investors' interest, like we had a conference a month back, the foreign clients, they were more interested in looking for bottom-up ideas around the mid-cap space. So that space is continuing.
Again, it's all single stocks and individual ideas, but there are some themes from where these come from. I mean, new energy transition. I mean, these are all sort of new exciting areas. There are lots of listed opportunities which were not there 3-4 years ago. So any themes you can identify which you think one should look for? I mean, as they say, fish where the fish are. So where are the fish?
So look, the names you mentioned, nothing new for us. Those are sectors and themes we remain bullish on longer term. Our analysts, for example, industrials analyst has been downgrading a lot of names in the last 3 to 4 months, given where the valuations are, given the earnings momentum. But that's a space to be in. Industrials, cyclicals, capex, specialty chemicals. The sectors where we are not so convinced yet at a broader level is pharmaceuticals, where we see very select opportunities, but broadly we see headwinds. The renewable space looks very exciting, very exciting. There's a lot more which can happen versus what's been announced. And we're already only seeing the early stage, you would say, of the listed universe participating in that in a big way.
When you say renewables, what part of the renewables chain?
The entire value chain, from utilities to suppliers to EPC companies. And we've seen the playbook happen in China last many years. It's early stage in India.
Is it driven by protection, though, a lot of it?
Look,
I mean, not right or wrong, but I'm just saying.
Forget right or wrong, but protection is also in the context of what's happening globally. If it's protection happening only in India, then it would be a worry from a longer term.
It's happening everywhere. So
if it happens everywhere, then it's possibly feasible.
Okay, all right. Tanvi, you come in on this. You know, we've got a new RBI coming up. Mr. Malhotra takes over from Mr. Das. Some would have argued that maybe, he should have got an extension of, say, a year or so. The bigger problem is the vice captain, so to call it, Mr. Patra as well, could be moving out. How do you see, the new governor in terms of a stance, continuity, as well as the key focal points that he'll have?
Sure, this is not the first time we are having a bureaucrat turned banker.
Indeed.
We did see Mr. Das have a exceptionally good tenure, and he was able to ensure that RBI's autonomy is managed, and at the same time was able to very strongly manage the relationship between the RBI and the government, something which we had not seen in the past, and there were always a lot of frictions which were out there. So we are more hopeful that even the new RBI governor will be on the same path. Irrespective of the RBI governor, our call is still the same, that the inflation is going to soften pretty sharply. We are already seeing the number going down from 6.2% last month to 5.5% in the month of November. Our forecast is saying that the inflation will be softening towards 4.5% by the month of March.
Okay.
So clearly inflation is softening. Growth is showing signs of slowdown, even though we do see some cyclical pickup in the second half, largely because of festive season demand, good monsoons now finally having impact on the rural sentiment, which were yet to be seen. And we are hopeful that the government capex spending will be picking up, even though it is going to fall short of the target. But I would say, irrespective of the RBI governor, we are maintaining our call that the policy stance as well as the rate cut cycle is going to start in India. The question is on the quantum of rate cut, how much opportunity will India have to cut rates, especially when we will see the new Trump administration resuming office in Jan, and what it means for the tariff hikes on China. I mean, that is all in the media. So our US team is expecting that 75% of China's goods get taxed as 60% from the September quarter. Okay. In case we do see any preponement of tariff hike, then I think the ability for RBI to cut rates will also get limited. So as of now, we are still having a 75 basis point rate cut, assuming Trump-related tariff hike only come into picture from the September quarter.
Sorry, you said 60%?
60%.
Yes.
China imports into the US.
Yes.
Right, on Chinese goods.
75% of China's goods get taxed at 60% in 4 tranches.
60% is what he said. Well, everyone assumes it now. It won't be 60. It'll be. That's just a starting gambit.
We still have that 60% tariff hike in our forecast. Wow. And that's why we reduced and lowered India's GDP growth to 6.3%.
Because, I mean, the general consensus view is that it's all China. It doesn't have any other impact. India is insulated. But it rarely ever works like that, right? I mean, there are second order, third order sort of implications, and it feeds through eventually.
Absolutely. So there are 3 ways India can get affected. One is a global growth slowdown, largely because of fading China as well as the US growth. And when US growth has been very strong so far. So India is a low beta economy, but India is not immune. So India will get affected indirectly. Second, the biggest risk, I think why we are downgraded India's GDP growth forecast for next year is that the private corporate capex recovery, which has been concentrated in a very narrow part of corporate India, might get further delayed and pushed out. If I'm a corporate, I would have, I always have that option of buying a cheaper import from China, especially when China has excess capacity to offload. And third, and I think the market is not discounting the fact what happens to RMB, because if you compare with 2018-19, RMB depreciated by 13%. China is going to appreciate against RMB. It makes a lot more sense. If I'm an Indian corporate, why not I import from China rather than expanding domestic investment in India? So I would say...
What's your rupee forecast? You think we're headed to...
We are actually expecting rupee to gradually depreciate towards 87. This is based on a 5% RMB depreciation, what my US and China team are forecasting.
Has to be, right? To stay competitive. It has to, I mean, join to the hip in that sense.
Yes.
Tell me just one point. Government stimulus will do the job, and we need both monetary and fiscal. But just there's an underlying worry, and this is a minority view, that maybe growth has now come back to levels where we were before COVID hit. I mean, that quarter, right? So you had this big COVID sugar rush after COVID. I mean, spending really boomed, and the top end really prospered and made money. And if people, especially who held stock, I mean, they made a lot of money, and it went everywhere. And now all that is kind of fizzling away, and you're coming back to trend growth. I hope that is not true.
No, absolutely not. I'm not of that camp, because I think the macro stability risk has improved dramatically since the COVID-19, before even the COVID-19 shock. Your balance sheet is much stronger. Corporates have used COVID as an opportunity to deleverage. Asset quality of banks, despite that massive credit boom we have seen, is still very much, or I think one of the best we have seen in 10 years.
Right.
Before the COVID pandemic happened, the growth slowdown was also partly because of NBFC crisis related after effect. I don't see much of an impact right now. So I think India is in a much stronger, much better position than what we were pre-pandemic. So definitely, I think the trend growth is more towards 6.5. That time we had reduced our trend growth to more towards 5.5, 6. So clearly, we are much better than what we were in 2019.
All right, Gautam, let's get you in then. I think all of us dream of having a better house, maybe a better looking one, a larger one as well. I've personally pushed back my plans for a few years, going by the kind of pricing that we're seeing. But that's a sector that y'all are clearly quite bullish on, right? Real estate. It's come back after a while. It's enjoyed the last 2-3 years or so. but you all believe there's a further runway from here. What's the geography you're most bullish on? And if you could help us out with some key points.
Yeah. So look, it's a broad view on the property sector, not just geographically.
Okay.
The argument being, like it's a cliched term, is this time different? But that's the argument our analyst is using, that this time is different, even though there is discussion that property prices have gone up. And the analysis is based on the usual matrix of affordability, inventory to sales ratio, demand supply, the structural demand trends, etc. On all the metrics, Indian property cycle is far away from reaching its peak.
Okay.
This is at the fundamental level. Now let's look at the stocks. Without mentioning individual stocks, even at the sector level, we are nowhere near peak in terms of where the valuations historically have gone to, or even globally where we see property is a very deeply cyclical sector, and there are accounting variances. But even then, what's the delta from bottom to an upcycle in terms of multiples? Indian property sector has a lot of legs left to go. So again, it's not just a 6-month call. It is one of the structural calls our analyst is making, and we all as a house are backing that property sector in India still has some years left.
Number of 100 crore houses which are being sold. I saw a report on the newspaper over the weekend.
Yeah.
I mean, just amazing.
So
I think that's a faster selling category, maybe, right?
So that could possibly reflect the wealth creation we are seeing in the country. And again, look, that's not the market of the sector. Yeah. That's a small part of the market. The sector,
but it's still premium because affordable is not doing well. I mean, there's no supply affordable, right?
Absolutely. So again, when we say premium versus say, I won't say affordable, but somewhere in between, that segment still has long legs to go. And we are seeing momentum there also.
So if you typically look at a cycle, which year are we in for the real estate?
So I think we at least 3 more years, unless we see an economic shock or something. We are at least 3 years away. Look, the biggest data point is the inventory to sales or the supply coming in. It's nowhere near any cyclical peaks. Nowhere.
Anything else from the listed, sort of large listed space, lots of plays which you think?
So utilities in the renewable space, we remain positive. Yeah. Then we are more cautious around autos and consumer discretionary. This is on the cautious side, which also we've been sticking to and still maintaining that view. We still haven't seen any signs of changing our view on that space.
Well,
quick commerce, etc.
Quick commerce, Quick commerce, you'll have a view out there. And the newly listed one, I think, is something that you'll like quite a bit out there. So if you could tell us between the one that was listed earlier, that corrected and then bounced back, and the newly listed stock.
I won't differentiate between the two, but we like both.
Like both of them, okay.
So our analyst is bullish on that space. Again, the simple argument is the opportunity set is just too big, and we are far away from reaching anywhere near peak penetration. So it's such a long runway for growth, and still the incumbents have an early start. You'll see more competition happening. But we have seen the playbook in multiple other subsegments also.
What does it mean for listed physical retailers?
So look, they are also trying to evolve and replicate.
There's one which is listing now, which is going to come list on Wednesday. There's of course the large, which is already listed stocks underperformed quite a bit. I mean, they'll have to evolve, you think?
They will evolve. They will have to evolve. Ultimately, everyone has to evolve in response to consumer asks. But the question is who can do it at scale as a third party and who can do it for their own business. And it'll be mix and match. So as a distribution channel or as a way to sell to customers, it will evolve. Absolutely.
You know, since we briefly spoke about China, normally when you talk about China, you talk about metals, talk about chemicals as well. So what's your view on both those two spaces? Because it clearly has an impact on the global space as well, both in metals as well as in chemicals. Any view?
So look, at a larger picture level, metals, we don't have coverage right now, so I won't be able to give a view. Chemicals, right now, it's stock specific. So it's an opportunity also as well as a threat. Like if there's a lot of supply coming in China, it's a threat from a dumping / oversupply, but also an opportunity for Indian companies in terms of the China plus one theme. So it's not a universal theme across the sector. Each company's own strategy. So that's the way our analyst has approached it. It's whichever company is better placed in the China plus one theme, we are bullish.
All right. And, you know, before we lead into our next conversation that we're going to have, what about the NBFCs as well as, you know, the banking space? There are reports that suggest that maybe credit growth is slowing down a little bit, and there could be some near-term pain as well in some of these NBFCs. How do you all approach that space? I think in banks, you're like the top banks, right? The largest private sector bank. So
we have been cautious on that space. Our analyst has been highlighting stress building up, including some early data points showing stress even in the CV sector, for example, beyond MFI and beyond unsecured. So, and we still don't see any signs yet from on the ground of it bottoming out. So You see early leading indicators of bottoming out. We haven't seen that. So we remain cautious broadly on that space. We are still cutting earnings in that space, except the large private banks or the SOE banks. We're still cutting earnings. So,
Tanvi, one is slowdown. Again, we have, by the way, the Chola management, one of the largest NBFCs, joining us on the other side. But one is growth slowdown because of the lending opportunities, etc. But the other is the RBI and what is done, right, in terms of cracking the whip. And 2024, we've seen so much action.
Yeah.
It's an unfair question, I know, and it's not like one size fit all. But do you think that also perhaps is the reason? Because so many players are in a way out of the segment, or products are out of the marketplace in that sense, and maybe that's also hurting at the margin. Do you think that'll change a little bit? Maybe a little bit of easing on the regulatory front?
That is what our base case is. So if I look at why my GDP growth slowed down so sharply to 5.4%, we need to take into account that there was a very sharp slowdown in headline credit growth, even though bulk of it was consumer credit. But even your headline credit has slowed from a peak of 18% to as low as 11%. And all that happened in a matter of 6 months. So going forward, we are actually expecting the credit growth to stabilize at around 12%. I would expect, I'm not building in more regulatory tightening in my base case when I'm looking at the growth forecast. We are assuming status quo on the regulatory front. So credit growth largely stabilizes at around 12%. That is what is feeding into my numbers. Obviously, we would prefer to have a better mix of credit rather than only focusing on consumer sector. Obviously, we would want a more broad-based recovery in credit, hopefully towards the industrial sector or the capex-oriented sector. But I think a lot of global uncertainty is in the price right now to actually expect that the credit growth could actually flow into industrials or the larger corporate in a meaningful way beyond the working capital
But the
demand
has to come from them, and which perhaps is not yet happening in a big way. Thank you both for coming down to our studios, Tanvi and Gautam. It's a pleasure. Appreciate it very much.
Thank you.
So that's the conversation for 2025 from the top UBS India team. I'll take a quick commercial break here. And as promised, that Chola conversation will follow in a bit. Market, by the way, is down about 50 points. We're at 24,700. And lots of stuff moving around, which we will address as well. So new names in the mix, which was not there in the morning. And some of them we'll address. But let's just take that quick commercial break. As I said, we all have the Chola management on the other side. We talk about H2 2025 outlook with Arun Selvan of Cholamandalam Investment and Finance.
Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by Century Ply Club Prime, Raho Befikar.
The man from Motilal Oswal is back.
I don't give tips, only solid advice. Guys, an app without an advisor is like a pen without ink. Always incomplete. Never forget the 3 R's of investment. Research, research and
Research.
sir.
The man from Motilal Oswal. Solid research, solid relationships. Before you invest, call us 92345 92345.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
This is TV18 and you're watching CNBC-TV18.
Presented by Punjab National Bank, the name you can bank upon.
Welcome back. Well, the markets are down a little bit in the last few minutes. We're down close to around 50, 60 points odd. But let's focus on the auto financial space now. The pain in the first half of the year was elevated for the sector. Is the situation improving the second half of the year? Will dispersal see a pickup in the second half? Is asset quality improving? Well, to understand all this, we are joined by the president as well as the CFO at Cholamandalam Investment, Mr. Selvan, who joins us on the show. Hi, sir. Good morning and thanks a lot for joining in. Well, tell us, what is your feedback? Second half of the year shaping up better? Are you seeing some kind of, a return in terms of growth rate? And a quick comment on asset quality as well. How much of pain is there in the system?
Yeah, we're seeing some return in, both demand as well as improvement in asset quality. I'll focus first on vehicle finance, which still is our largest part of our portfolio. In the vehicle finance, while CV's growth is still a bit muted, We are seeing some traction in heavy commercial, especially in the segments we are working with in the small road transport operator segment. And our used vehicles as well as passenger cars and MUVs are showing reasonably good growth. Tractor is picking up, while we are not seeing that much traction on the CE as well as on the mini LCV types. So it's a mixed bag, but we see the rural coming back with the tractor and some amount of PVs picking up in the rural, and the light commercial and the heavy commercial vehicle. Okay. With regard to LAP, we are seeing good growth there, and with regard to affordable housing, we are seeing good growth.
Okay, all right. But tell us, is there a perceived slowdown in business momentum? Could you tell us what is hurting? Is it inflation that's hurting? Is it higher interest rates that's hurting? Because various pockets, the feedback you get is there is some kind of a slowdown. Are you experiencing that? If yes, which segment and what's the root cause?
Yes, in the as I was saying, in the CV segment, we still have not seen the full comeback which we expected to happen in the third quarter. While October was a good month, November sort of mellowed down, but we are expecting December volumes to pick up, especially with the calendar year coming to a closure and the model changes that would come into play. So we are seeing a reasonable growth. It will be certainly a growth over last year's same quarter as well as Q2 of this year, but it may not be a large growth that might have been initially thought about.
Right, Mr. Selvan, good morning. Prashant here. Sorry, just to pinpoint on commercial vehicle side, sir, could you give us some sense? What has growth been like and what do you expect for the full year?
So the vehicle finance overall, it will clock a growth in the range of around 12 to 15% on the disbursement, and on the asset side, it should be in the range of around 15 to 20%. This is what we are seeing as we move into Q3, Q4, because these 2 quarters last year has been fairly good, but still we'll be better than last year. It may not show a significant good growth. Our used vehicle traction is good, and we are seeing passenger vehicle also growing in a reasonably good shape. But we still have to see the growth coming in the heavy commercial and the light commercial vehicles.
And those growth rates which you mentioned for Q3 and Q4, you think it's a bit lower as compared to what you imagined you would be at when you started the year?
It would be more or less similar from a vehicle finance perspective, because we had factored in that these would be a little slower growth. See, what is happening is we are able to manage the similar level of growth because we have the product diversification. So whatever we are seeing as a slowdown in the new commercial vehicles, we are able to manage it with the help of used as well as the increase in the passenger cars. Two-wheelers have sort of stabilized. It is not growing aggressively. It is sort of keeping at the same pace as what we have done in the first 2 quarters.
You're not dependent on one segment, and I think you kind of managed to sort of press the pedal on other segments when growth somewhere else slows down. So overall growth guidance remains same, 25%?
Yes. Overall, company as a whole, including VF, LAP and other products put together, we still see the growth at the 25% number. I know it was being pushed to 28, but I think we should keep it at the lower end of the 25 to 28 forward statement we had discussed earlier. We should still clock 25 plus.
Okay, all right. Mr. Selvan, what about the new business? As a proportion of your total mix, how do you see that improving, and what will be the ideal contribution to your total business going ahead? If you could give us a time frame as well as contribution percentage.
So the new businesses will continue to be less than the 15% number which we had been, in the first half of this year. The mortgage businesses, which is the LAP and HL, will be the one which will see growth at the cost of a slight proportionate reduction in the vehicle finance. So you will see vehicle finance coming to around 54-55%, and then the mortgage businesses growing to around 32-33%, and the balance coming in from the new businesses. The unsecured will remain at the 8 to 9% level, and there will be growth in the SBPL and the SME segment to make up the balance 100%.
Okay, all right. Mr. Selvan, final question before we let you go. Give us a comment on the net interest margins. How do you see that shaping up? The RBI in all probability will start cutting rates from early 2025. So how do you see your NIM shape up from here on? And also quick comment in asset quality. I recall in the Q2, the provisions had spiked up, and you explained that to us as well. But could you comment on both these two, NIMs and asset quality?
The NIMs will marginally improve. We are not factoring in any rate reduction by RBI, at least for this financial year. If at all it happens in February, the impact of that would be marginal to the extent of only 1 or 2 months at best. So we are not factoring in, but we are seeing some amount of benefit because a lot of our borrowings have been benchmarked with the T-bills and money market linked instruments. So that has given us some improvement whenever there have been fluctuations in these instruments. So NIMs will improve with also the increase in the marginal yield as well as the book yield of vehicle finance, which we, as you recall, we have been talking about the mix to change as it moves into as the old book, which was dispersed during the COVID period, runs down, and the new book with a higher yield becomes a larger part of the book in vehicle finance. With regard to asset quality, yes, we did see some increase in Q1, Q2. You will see some drop in Q3 and more in Q4. This again we had iterated when we spoke earlier.
Mr. Selvan, we'll leave it there, sir. Thank you very much for joining us. It's a pleasure speaking to you, as always, and getting a sense of what the rest of the year perhaps is going to shape up like. Some numbers there from Mr. Selvan at Chola Finance as well. We're going to take a quick commercial break here with news that I think the market's also recovering. About 10 points or so is what the Nifty is trading, down by. And lots of new names, as I said, and we'll come to some of these stocks which are jumping around in a bit from now. Well, it's holiday season, and this is the time, of course, the best quarter for the hospitality sector, the hotel sector as well. How's demand shaping up? What are room rates like? And is it as strong like it has been for the last couple of years since COVID? We're joined by two hoteliers. We have Ashish Jankanwala, Chairman, Managing Director and CEO at Sami Hotels. Nikhil Sharma is Managing Director and Area Senior Vice President, South Asia at Radisson Hotels. Gentlemen, good morning. Great to have both of you here. Appreciate your time. Prashant this side. Ashish, let me start with you. How is the third quarter panning out like? The big sugar rush post-COVID, has that lasted into this quarter as well? In terms of occupancies and room rates, is there any softening at all, or is it all up and up? Go on.
Hey, Prashant. So thank you for having me on the show. First of all, there's no sugar rush. COVID was bitter, and I'm glad that it's over. Whatever you're seeing in terms of performance is pretty stable. It's going to last us quite a few years. And this quarter is no different. So we've seen really strong performance continue this quarter. And it's been, as I said, something that we've seen coming in for a very long time.
So the third quarter, so far what you've seen, of course, we can't talk specific numbers, sort of big, much better than Q3 of last year?
Yeah, so we can see even for Sami, at least because we run a large part of business hotel portfolio, we had seen even Q1, Q2 grow very strong over last year, same time. And Q3 continues to maintain that trend, almost maintaining a double-digit revenue growth over last year for same-store hotels. I'm not talking about new inventory addition and all. So yeah, it remains pretty strong, actually.
All right. Hi, gentlemen. Good morning, and good to see you. And you all seem to be in the best possible sector, and the best possible time. It's the most wonderful time of the year. Ashish, give us some numbers. I recall when we chatted last, you were talking about double-digit revenue growth for FY25. Is that well and truly on? Could that be a surprise on the upside? And if you could quantify it, what could be the rough range? And I think you were suggesting that the adjusted margins were at around that 40% odd mark, and you were confident of holding out there. You reiterate that confidence?
Yeah, so I think there is no reasons to worry about maintaining a double-digit total revenue growth, and I'm talking same-store assets, and also the margins keep improving. This quarter and the next quarter, which is quarter 3, quarter 4, it's a rate.
Okay, all right. I think we have lost Ashish's audio, but I think we'll get back to it. The broad point was there's no big reason to worry. So that's good news. But in the meanwhile, let's get Nikhil as well into the conversation. Hi, Nikhil. Good to see you, Ben. Well, could you tell us what is your total portfolio like right now? How much of your portfolio comes in from tier 2, tier 3? And what is the kind of demand you've seen in this third quarter if you compare it with the previous ones?
Nigel, thanks for having us. Radisson Hotels in this country operates almost 130 hotels. We are in 78 cities as we speak. And I would say about 50% of our portfolio today is broadly between tier 1, tier 2, tier 3. And I would differentiate leisure as a segment by itself. So really, the Saputara, Lonavala are really leisure segments in themselves, and I wouldn't categorize them in tier 2, tier 3, tier 4. Of course, this is the best quarter for us as the industry, and at Radisson this year, we've seen average ADR go up by 10% in our like-for-like hotels, and for us, meetings and incentive, which is MICE, is a big contributor, and we've seen a 12% increase over last year.
That's good to hear. Sorry, Nikhil, overall, in terms of Q3 over Q3 of last year's, again, double-digit kind of growth?
Absolutely. And I know Ashish will hate me for saying this, but the best ever quarter, because Ashish has an analogy to it, and he should answer that. But this is the best November that we've seen at Radisson Hotels from a revenue perspective and from a growth perspective, and December is going to be better than November, and that's historically the best ever quarter for us. I mean, it's true for the industry as well.
I completely agree. We have Puneet Chhatwal here. I remember speaking to him, and I remember him using that same phrase, best ever. And he's used that now for many quarters. So it is indeed been a super time. Ashish, you want to take that? Nikhil wanted to toss that to you.
So listen, my view is that the demand supply in the hotel sector will keep delivering best ever quarters for several years to come. It's like me saying I'm older than this year than I was last year. Growth is imminent. I think the way we interpret that is it's just the beginning. Hotel rates in India are still not, they have a huge headroom to grow. So I think we shouldn't be surprised about the fact that every year you will see a reasonable growth. Our long-term forecast shows anywhere between high single digits to early double digits, sustainable growth rates in total revenues, So I'm not surprised. Obviously, I'm very pleased, but I'm not surprised that everybody will say, this was my best ever quarter. Just as I would say, I'm older this year than I was last year.
No, that's well put. Ashish, but we had, so what is driving, is this change in something, so I used the word sugar rush, you said there's no sugar rush. But something is different, right, compared to where we were in 2019. And what post-2020 has been like. And what people want to do, I mean, things change. I mean, consumer habits change. Quick commerce, for example, is an example, right? Very quickly, how fast consumer habits have changed. I don't know if that's a correct analogy, but do you agree? Is that, or you think this was anyway going to happen? What's your sense?
No, I think a large part of this was in any case going to happen because between 2008 to 18, the whole industry was getting built. And you saw some sort of a disturbance as any sector gets built. But 2017, 2018 onwards, most of the large cities had started stabilizing on new supply. And I can be very certain that as supply situation stabilizes, there was always enough demand for accommodation options or hotels or tourism in India. So I think it's very, very solid demand supply. We don't see supply catching up with demand in the next few years. And that's why, as I said, when demand and supply are so favorably stacked in favor of a sector, you would continue to see strong performance. There would always be disappointments about a quarter or two about the last year base, so on and so forth. But we've seen how last year people were worried about, you had G20, you had the World Cup. Everybody was worried that is that the peak and would you be able to deliver growth above that? But as I said, we have seen double-digit growth on same-store hotels in spite of kind of inheriting a very strong base last year. So I think it's solid growth. I think it's more like protein than sugar rush. It's building up your muscle, so it should last you a long time.
Ashish, easy to say you're on that side. I'm taking my family of four for Christmas out, and I think it's burning a lot of my fat, I think. So, just thinking about the kind of expenditure. But it's all for a good time, and memories is what I understand is what makes it all worth it. But let's talk about business then, Ashish. Let's get a couple of numbers for you. Your debt reduction plans, well, they have been going according to plan. Could you tell us by the end of this fiscal, what should your debt number look like? And before we had the bit of that audio problem, you were going to tell us about the profitability aspect as well. Adjusted EBITDA margins, how does that go? So comment on both these two.
Yeah, so I think we have seen our stable portfolio cross 40% EBITDA margins. And I think over the next few quarters, you would see the whole business kind of getting towards that. So we're pretty happy with where the margins are. We think there is a reasonable headroom for growth as far as the margins are concerned. At a company level, we should report higher than 40% margins over the next few quarters. So that's one. I think in terms of leverage, we are very comfortable right now. As you know, we've been reducing leverage ever since we went public. We are generating free cash quarter-on-quarter basis. So we're doing two things, of course. One, that gets used towards reducing leverage. But even more important than that, as you know, we have invested some bit of a capital in growth projects. And most of our growth projects are very short capex to revenue cycle. So as we put capex, we expect the corresponding revenues to come over the next few quarters. And that will further help us deleverage the business because we're not really using any leverage for growth, So I think combination of free cash and then free cash being used towards both deleveraging and growth is really helping us kind of accelerate the whole deleveraging plans that we have for ourselves.
Okay, and I think the last recorded net debt number we have is 1,900 crores. As you said, you're throwing up a lot of free cash. Where is that number headed?
For now, it's around the same number because we used about 200 crores of free cash in October for our acquisition in Bangalore. So while our gross debt remains the same, our net debt slightly increased because of the utilization of cash for the Bangalore acquisition. But that acquisition will start throwing up both revenues and profits over the next few quarters. So eventually, it will then adjust our total net debt to EBITDA ratios.
And also, you were talking about this Navi Mumbai real estate that you all had, which you all could potentially set up, I think a 300, 350 hotel out there. Give us an update out there. Maharashtra elections are out of the way. What's the progress on that front?
No, so I think we had a very constructive dialogue with the administration before the elections got announced. And of course, then we went into a silent period. Now that the elections are over, the new government is in place, we will kind of re-engage with MIDC. We believe that we have the right merits and the reputation to make that investment in the state. And as I said, I remain fairly excited about about Navi Mumbai as a future market. And you're right, it should potentially give us about 350 total inventory.
Okay, all right. Well, Nikhil, before we let you go, any plans of listing the company? Just look at the valuations. Ashish is smiling cheek to cheek. We have Mr. Puneet Chatwal as well. I met him a couple of weeks ago and he said, Nigel, I'll promise and I'll over-deliver. I'm so sure. Any plans in listing?
Nigel, not at the moment, but never say never. And just to your point on taking the family, you need to be more in touch with hoteliers because I can tell you we're seeing a 7 to 8% increase just in the holiday season, whether it's Kashmir or Goa. A lot of media reports that said Goa is down and out. It's not really down and out, at least not for December. It did see a dip through the year, but it's not seeing a dip anymore in this quarter.
I just had one last question to Ashish. Ashish, and you sort of you said best ever and protein, and I like that protein, not sugar rush. As they say, right, what is worth doing is worth overdoing, and we've seen that in the real estate sector. Is supply going to overwhelm, or is it really far out? I mean, at least for the next few years, you don't see that.
So I think in the large markets where the current pace of supply is upwards of 8,000-9,000 rooms, you would see that supply is not able to catch up with demand because demand is definitely growing in that 8 to 12, 13% CAGR, right? So for supply to grow at that rate, you're talking about 700 rooms to 2,000 rooms opening every single year. I'm talking about different markets. So I think large markets which have a good supply base today, I feel very, very comforted by the fact that supply will not be able to catch up with demand growth. In some of the smaller markets, things can be a little bit more volatile over the years, where let's say the current base of inventory is 2,000 rooms or 3,000 rooms, and therefore 10% supply growth is, another 200-300 rooms really, So we've always said that we find greater comfort and margin of safety in larger office markets or larger hotel markets, where I'm quite confident that supply will find it really hard to catch up with demand, and definitely not in the next 3 to 5 years.
All right. So, I mean, a clean runway in that sense for hotel companies, and many years, at least a few years of double-digit revenue growth, top-line growth is what we should expect, as you put it. Both Ashish and Nikhil, thank you both for joining us here on CNBC-TV18. It's a pleasure, and I should end this conversation by saying happy holidays. Thank you very much for being here. So that is a discussion on hospitality and hotels as we wrap up the year. Q3, the best of the year. Well, Wockhardt stock is surging. It's up 10%, started higher, and I think it's only picked up steam. Vinny's here to tell us why, what's happening. Vinny, morning.
Good morning. So absolutely the most important drug that we talk about when you talk about Wockhardt is the cancer drug, that is WCK 522222. So that is Zynic. Now this drug is an important one for Wockhardt. We've seen that, since the approval is coming for this drug, the stock has been buzzing. Now they've said that there's a successful use of this drug in the US for a cancer patient. So this indicates that, this drug is working out well. Till date, they've tried it out on around 45 patients, which have benefited from this compassionate use of the drug, and that is why a positive up move that we are seeing coming in for Wockhardt hospitals, because there's a positive news there. And the new drug discovery portfolio is also focusing on meeting all these unmet needs which are there for antibacterial drugs. So keeping an eye out on this one, because it's an important one for Wockhardt, and any news, any positive news on this front works well for Wockhardt.
All right, no, absolutely. That's a big one for them. 15.24 on the stock. We'll take a quick commercial break here. Mitesh joins us on the other side. Coming up.
You have been the driving force behind India's iconic businesses. Here's a unique opportunity to invest in the iconic businesses you believe in. Invest in Aditya Birla Sun Life Conglomerate Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
टिप चाहिए? पैसा लगाना है? तो सेंचुरी प्लाई क्लब प्राइम पे लगाओ। डूबेगा नहीं, जलेगा भी नहीं, कोई खा नहीं जाएगा और मिनिमम 30 साल का रिटर्न देगा। अब इससे बेटर इन्वेस्टमेंट है तो बताओ। सेंचुरी प्लाई क्लब प्राइम, रहो बेफिक्र।
That's okay. फिर से ट्राई करते हैं।
जो फाइनेंशियली सिक्योर होते हैं वो मिस्टेक से सीखना अफोर्ड कर सकते हैं, तो इन्वेस्ट करते रहो, बढ़ते रहो। बंधन म्यूचुअल फंड, बढ़ते रहो।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।
इसे एवर रेडी अल्टीमा का लॉन्ग लास्टिंग पावर चाहिए। टॉयज से बच्चों की इमेजिनेशन चलती रहती है, इसीलिए इनकी बैटरी चलती रहनी चाहिए। नई एवर रेडी अल्टीमा बैटरी है 400% लॉन्ग लास्टिंग।
यार सुनना, आजकल ये इक्विटी मार्केट ना बहुत ऊपर नीचे हो रही है, क्या करूं?
माफ कर।
पालकी, डेट में इन्वेस्ट किया है तो गोल्ड ऊपर जा रहा है, क्या करूं?
माफ कर।
माफ कर। इक्विटी या डेट?
माफ कर।
यार गोल्ड ऊपर जा रहा है।
माफ कर।
किसको? यार पहले तुम लोग ना हर बार फाइनेंशियल एडवाइस देते थे,
अभी भी दे रहे हैं। माफ कर।
यार ये
माफ यानी मल्टी एसेट एलोकेशन फंड्स, जो इक्विटी, डेट
और गोल्ड
में एक साथ इन्वेस्ट करते हैं।
वाह,
जब इन्वेस्ट करना हो बेफिक्र
तो माफ कर।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेजों को सावधानी से पढ़ें।
One look and I'm falling for you like crazy, crazy. Boom, boom. Every heartbeat is only for you. Every breath, every moment with you. My heart goes boom, boom.
Unlimited love. XEV9e Mahindra Electric Origin SUVs.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Welcome back. 30 points lower, 24,740 is where we are at this point. Mitesh is back with us with what he wanted to do. Mitesh, good morning again. So it's a quiet day, at least for frontline indices. What would you want viewers to do?
Yeah. So Prashant, it's a quiet day, but some stock specific action is happening definitely for sure, and ITS still remains a good back. So, from there, I would recommend buying into Naukri. Buy here with a stop at about 87.30 and a target of 9,000 can be looked at. And the other one is real estate, and I have a buy on Lodha Developers, which is making a fresh swing high. So keep a stop below 14.35. Look for targets of 15.20, 15.30.
Got it. What we'll do is we'll take a quick commercial break here. Mitesh, thank you very much for that. Our special Indianomics segment on the other side, Lata gets speaking with Lohit Bhatia of Quest Corp, Mr. Balakrishnan of Center for Development Studies, and Amit Basole of Azim Premji University to discuss why salaries in India are not rising or not rising at a fast enough pace. That's a conversation. Interesting one. Stay tuned. Coming up.
Mutual Fund Sahi Hai presents Nivesh Ka Sahi Kadam in association with News 18 Network.
A new job means a better salary, and then come bigger dreams like buying a car. But first we have to find out how much you need to accumulate to buy the car of your choice and in how many years. If you want to invest for 3 to 4 years, then you could choose an equity hybrid mutual fund and can start an SIP in equity hybrid fund and increase your investment year after year as the salary rises. Because with time, the prices of car will also increase. Also, if you want to spend on shopping and watches and lavish dinners, you could look at following the 50-30-20 rule, that is 50% of the monthly salary for the essential expenses, 30% for your hobbies and 20% to be invested. But if your responsibilities are less, then you can invest more than 20% to achieve your goal quickly. Now, last but the most important thing before investing, do take the advice of your investment advisor because they can help you choose the best fund for you considering your salary, expenses and risk profile.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Cruising down the highway, yeah, I got you by my side.
Every drive feels safe and special with collision mitigation braking system and other intelligent ADAS safety features in the all-new Honda Amaze, here to outclass.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
International Gemological Institute India Limited, one of the world's leading independent certification services providers for diamonds, studded jewelry and colored stones, with a full stack of offerings covering grading and classification across different stone types, now makes an initial public offering of equity shares the face value of ₹2 each for cash at a premium. The 100% book built offer being offered in a price band of 397 to 417 rupees per equity share, opens on December 13th and closes on December 17th, 2024. For risk factors and more details, please refer to the red herring prospectus.
बच्चे तो अपनी जिंदगी की खोज में निकल जाएंगे, जरूरी है अपने रिटायरमेंट के लिए प्लान करना। HDFC लाइफ, सर उठा के जियो।
Samman Capital Limited announces a public issue of secured redeemable NCDs offering coupon rate of up to 10.75% per annum. Tranche 2 issue is open for subscription. To subscribe, log on to www.sammancapital.com. For risk factors, detailed disclaimer and more details, please refer to the Tranche 2 prospectus available on the websites of SEBI, stock exchanges, company and the lead managers.
Welcome to an all-important Indianomics discussion, a report by Quest Corp, the staffing company, on wage growth in the corporate sector in India published in the Indian Express has made policymakers sit up. The report says that average salaries in India over the past 5 years have risen by just between 1 and 5% per annum, which means, adjusted for inflation, people in the formal sector are earning less than they did 5 years ago, adjusted for inflation. Possibly in response to this report, the Chief Economic Advisor, V. Anantha Nageshwaran, has been advising India Inc. that there will not be enough demand for the products made by their companies if they pay their employees too less. So, the question is the steep slowdown that we saw in the second quarter GDP and in the corporate earnings, EPS growth, in the second quarter because of low wage growth? And how does one resolve this? I have with me the author of the Quest Corp report, Lohit Bhatia, President Workforce at Quest Corp, and economist P. Balakrishnan, Professor at the Center of Development Studies, Thiruvananthapuram, and Amit Basole, Professor of Economics, specializing in labour at Azim Premji University. Professors and Mr. Bhatia, thank you very much for your time. Lohit, since this is so much about your report, please tell us the top 3 or 4 takeaways from your study.
So thank you very much, Lata, and glad to be with you on this show today morning discussing this all-important topic. This report was conducted and a detailed research was done somewhere at the beginning of this calendar year, and it was finally published a few months before the budget. In this report, we came out with the large macroeconomic data when it comes to employment and the job creation. The second, what we spoke about is what is the total labor market and how does that get subdivided. And the key takeaways from this report is all of us know we're about 140 crore Indians. In the working age population that is 15 to 59, the labor force participation rate is now a little over 61%.
Yes.
That's about 55 crore people. We also said that, by the way, contrary to popular belief that enough formal work is not getting created in the last couple of years, just in the years between 2017 to 2023, as per the EPFO data, about 6.7 crore people came into the formal work and created what is called a UAN or a universal account number. However, when you sum total all of these categories, we still said that a little over 11 crore people have some shape and form of formal work in India, which means that out of the total labor force, which is at about 55 crore, formal work at 11 crore is just about 20 or 21%.
Okay.
And that's what a report was talking about. The key recommendations which went to the policymakers before the Union Budget 24 as well was that how can the government aid and abate, and grow this sector.
Okay.
And last, before I pause, one of the key recommendations that we were speaking about was incentivizing formal job creation, which in many ways we see as the ELI, which came out from the government.
Fair point. I mean, that's very thorough. But what got published in the Indian Express and what led to the CEA's comment is the level of the salary. I mean, besides the fact that you're only giving us nominal, you're not adjusting it for inflation. And even then, the growth in the BFSI sector is just 2.8% for those 5 years, compounded annual. For engineering, it's terrible. Engineering, manufacturing, infrastructure, we would think is important. And, you would have engineers there. And that is just 0.8, less than 1% growth every year. Likewise, I can go on. That salary increase looks very small. Actual salaries is terrible. You're telling us it is 17,500 in BFSI and some 20,000 odd in other sectors. Only IT looks a little respectable at 40,000. I mean, these are average salaries. They are that low?
So let me clarify a few points here, Lata. First, this is from the period 2019 as a base to about 2023-24. This also had 2 years of COVID in between. This data is predominantly for the 600,000 workforce that work at Quest. Now, Quest, as you know, is the intermediary of getting people from the informal labor market to the formal labor market for the very first time. So A, you're dealing with entry-level workers. B, you're dealing with workers who are typically on an outsourced role. C, you're dealing with people who are either freshers to 1 to 2 years of experience. And D, you're dealing with a base which was 2019, and then we had 2 years of COVID impact. Now, let me just add one quick dynamic before I pause here. India's minimum wage average still continues to be at about 13 to 15,000 rupee. Now, many states are below the 15,000 rupee mark. And had Social Security Code or the Labour Code being implemented, which is already approved by Parliament more than 2 years ago by all the states and ratified, we would have been in a situation where a national floor wage would have come out. So again, coming back to this point, I think you have to keep that in context.
No, I take your point that these are COVID years and these are entry-level workers. Those are two very important takeaways when we measure this. But I mean, it's still like, you know, how does a person live in 17,500 rupees? It looks a little tough. And this is formal sector. What happens when people are not in the formal sector? Amit Basole, you're the master of that data. You tell us, if this formal sector data is so shocking, is it worse in the informal sector? You know, maids and gig workers, I think in Mumbai earn a little more.
Right. Thanks, Lata. So I think, if you look at the periodic labor force survey, which is the official employment survey of the government of India, comes out annually and gives us a picture of the entire workforce. There too, the story is similar in the sense that wage growth has been very tepid. In fact, I would say earnings growth in overall, because it measures self-employment earnings and regular wages and casual wages, gives us the trends for all of them. And since the survey started coming out in 17-18, the regular wage growth has been barely, let's say, 2% or 1% annual. Self-employment earnings have been doing even worse, and we can come to that later if you wish. So the story is corroborated on on the wide labor market. The one bright spot, so to speak, is casual wages, which actually have been growing quite strongly in PLFS. Not much has been talked about over there. So something to perhaps explore. But yeah, on regular salaried work and so on, the story checks out on the entire labor market as well, including informal.
And the actual salaries also will be, below 50. As Lohit pointed out, informal would be like 13,000 perhaps.
Yeah, the levels are also not that different. If I recall correctly, the average regular salaried worker in PLFS would be somewhere around 15,000 rupees per month.
Okay, so in the first level of formality, they are not earning much more. It's just that it is formal and they probably have ESIS and those benefits. Dr. Balakrishnan, now to come to you, sir. We all sat up in terms of the growth suddenly capitulating to 5.4% and that getting corroborated by corporate India. If you think GDP is not very clean data, corporate earnings growth is clean data. That earnings growth was like, less than 5%, low single digits in the second quarter. Is there a sudden development in terms of the labor market going astray?
I don't think this is so sudden, because if you look at two sources, one is the PLFS data and the other is the data for rural wages from the Labour Bureau. Over the past 5 years itself, real wages have declined in some areas and some sectors very drastically, by about 25% for the self-employed earnings, that is, over the past 5 years, except, interestingly enough, for casual workers, whether you look at the similar Labour Bureau data or the PLFS data, for casual workers, it's increased. So, but for all other sectors, it's decreased very substantially. I just want to say that, in my view, this is not a particularly a recent development. It's been happening for the past 5 years, and it's not surprising because the inflation rate has been very high for the past 5 years, right? The food inflation rate. Yeah, so it makes, and inflation, but especially food inflation. Okay. So it's not surprising. It's not all that recent. And while the data on the corporate sector is very, very clear, and we have to thank Quest for it, I just want to say the problem is probably wider than just the corporate sector in India.
Okay, no, Dr. Balakrishnan, let me rephrase the question that people have as investors or as observers of the economy. One interpretation of the slowdown was that fiscal spending just collapsed in the first quarter and the second quarter of the current fiscal because of elections and because of perhaps extreme heat. We got all those reasons. And because the Reserve Bank's policy for other reasons tightened because of dollar buying and liquidity, dollar selling by the RBI and liquidity tightness, they went after unsecured loans. We thought that was the reason for the slowdown. But are you saying that those are temporary and this is the bigger reason, or is it the other way around?
I would say that. I mean, it seems to me that whatever has been budgeted, maybe capex in the past 6 months has slowed, I believe. But the RBI's role cannot be very great because the rate of interest, which is the key variable, has remained, nominal rate of interest has remained the same for the past 22 months or something. So I would say there's a deeper problem of declining real wages, and maybe the immediate problem could be that capex has not been maintained. Sorry, the central government's capital expenditure, not the private sector, has not been maintained at the same level as it was in 23-24. So that's my view.
That's in calendar 2024. Clearly, for 6 months, they did not spend as much as the budget estimates indicated. Lohit Bhatia, this is more an economist's question, but I'm still asking you because you handle wages and staffing so much. This kind of wage levels are coming at a time when inflation, food inflation, for the last 18 months has been running at between 8 and 10%. Food inflation. Overall inflation, of course, has been a little more benign, hugging the 5 to 6% mark. Now, is there not an upward pressure, or are people still able to keep wages so low, the staffing companies and those whom you supply labor to?
I'll go back to where I began from. I think in the entire labor force that India has for our working population is about 55 crore. We've still been able to bring only 20-21% of those into the formal work.
Yes.
So today, this conversation of people at about 2.4 lakhs per annum, is it good? Is it bad? With Social Security, are they able to sustain or they're not able to sustain? Is a conversation on the basis of the balance 80% which don't even have this. I think the important aspect is the transition from that informal to formality, because that's when your wages actually start to kick in and become meaningful in nature. Let's take an example of 90,000 crores a year goes into Manrega. But even today, when we obsess on Manrega, an average worker earns no more than 30,000 in a year, not 30,000 in a month. If you look at a casual worker, let's say somewhere in rural India or in semi-urban India, they earn less than 5,000 or 6,000 rupees if they're associated with any of the Anganwadi kind of a work.
Got it.
Now, that's the kind of worker that we first need to bring in. That's the first point. Second point, coming back to your very specific question, does something need to be done on wages?
1 minute. Lohit, I'll keep that for after the... for a little later. Let me just get Dr. Balakrishnan in very quickly on the point. Where do we see things to be repaired as we, expect that 7% growth? Since we have been having decent growth in the last 3 or 4 years, and we suddenly saw this drop, do we first fix the fiscal deficit and the, RBI's tight liquidity policy? Will that keep us still at 7%, or is 7% difficult unless we graduate more people to at least the lower middle class?
Well, if the private investment rate does not really take off, clearly growth can be maintained only if public investment or public capex remains very high. The other is, I think the main thing to try and fix now is inflation. Without fixing inflation, you can't fix the slow growth of consumption, which lies behind the slow growth of manufacturing output in particular, and the economy more generally. So yes, capex will have to remain, though some of it is depressing in the destructive impact that some public investment is happening on natural capital, etc. But from a macroeconomic point of view, that would be necessary if private investment is not buoyant, and you must fix inflation. RBI's role, in my view, right now is not very great.
Yeah. No, I take your point entirely, sir. RBI can fix perhaps core inflation. They can't do much about food inflation. And maybe the missing chairs in this discussion would be perhaps people like Professor Ramesh Chand and Dr. Gulati, who would tell us why is food inflation for 18 months so stubbornly high. Either it is pulses, or it is potatoes, or it is other veggies. But that discussion for another day. For the moment, we have to take a break with the conclusion that it's a combination of causes, both fiscal spend being low and urban wages not taking off, urban jobs not taking off, and rural wages, of course, suffering as they always have. That's the cause of the slowdown in the economy. We will come back and look for solutions from our experts back in a minute.
Presented by Punjab National Bank, the name you can bank upon.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
यूं ही नहीं मैं बन जाता हूं। कुदरत के कोने कोने से खूबियां खोज लाता हूं। गुणवत्ता की गहराइयों का गोताखोर हूं मैं। यूं ही नहीं मैं रजनीगंधा बन जाता हूं।
This video might lag, but my Angel One app runs smoothly.